While 2024 was a strong year for equities, another part of the market put in its best year since the financial crisis, returning around 25% to investors. That would be the preferred share market. Joining us now to discuss the outlook for the space is James Hunter, VP Director and Portfolio Manager with TD Asset Management. James, great to have you back on the program.
Hi, Greg. It's nice to be here.
I find that's a really fascinating part of the market. I didn't know until you and I chatted ahead of the show that it had such a great performance in 2024. Walk us through that.
Yeah, I mean, it was a fantastic year, up 25%, best year since 2009. It didn't really matter which part of the market you were in. Floating rate preferred shares up sort of 16, 17%. Perpetuals were up close to 20, and rate resets were up over 30%. So it was really a great year across the board. If we think about why that happened, a couple things came together. So if you remember at the end of 2023, we had that favorable resolution to the potential tax changes that were going to affect some investors in preferred shares. So that was put by the wayside, and that was a catalyst that invited investors back into the market. The second part was we didn't get a recession. So bond yields remained elevated, credit spreads were really tight. That's a good environment for preferred shares. And then the third one is that the issuers were redeeming certain lines of preferred shares, and many of those redemptions were actually a surprise. So issuers are calling in prefs at par, $25. They're shifting to other forms of capital. So those three things work together to really push the market higher.
All right, so let's start breaking those buckets down. The return of the institutional buyer. I want to touch on that. What was happening in the space to have them move back in that kind of manner?
So if you look at Canadian preferred shares, we did a study when this sort of issue first came out in 2023 where the federal government was going to introduce a tax on financial institutions. And we were trying to understand, well, what percentage of the market would that impact? And we looked at it and we figured about 15 to 20% of the market were these institutional investors specifically within financial institutions, like mostly insurance companies. And that's a really important part of the market. It provides a floor to pricing when prices are really weak, and it imposes discipline when pricing is really strong. And so by allowing those investors to continue to receive their tax credits, which, there's debate around whether that should or should not be the case, which is not for today's discussion, but by allowing them to keep those tax credits, it really invited all those investors back for 2024 because they really just took a pause in 2023. It's an important, disciplined, and deep source of the market, so it was just really good for last year.
Okay, you mentioned the fact we didn't get a recession. I think we understand that one. But when you talk about those redemptions from issuers, what happens there? If someone's not familiar with the preferred space, what exactly is going on when they redeem them?
Right, so quick overview, if you look at the issuers of preferred shares, it's sort of like 60% or more financial institutions in Canada, and then there's maybe a 30%, which is pipelines and utilities, 10% a variety of other issuers. But it's mostly financial institutions. And a couple years ago, the financial institutions had a new source of capital available to them. It's called a limited recourse capital note. And so these issuers have been moving to that source of capital, that funding source, because it's a little cheaper for them. And it specifically is targeted towards an institutional audience. So issuers have been calling in their prefs, and they've been reissuing other types of capital. It saves them money, and it gives them a pretty stable investor base. So that's been driving a lot of the redemptions. But the other thing is that interest rates have just gone higher than really anyone would have anticipated 3 or 4 years ago, especially at the depths of COVID, when expectations for inflation and interest rates were really subdued. So there are some preferred shares that trade with a really high reset spread, 400 basis points or more. All of those securities would be really expensive for the issuer if they reset, and so the issuers are calling them in.
All right, so a pretty fascinating year for the space in 2024, a lot happening there. Now that we're into 2025, what are you looking at in preferreds in terms of expectations or sort of events to watch?
Yeah, that's the key question, and I think at this point our outlook is neutral. You're still seeing a good 5.5% yield, and there are still many parts of the market where securities haven't reset their dividends for 5 years, and so they're resetting at higher rates. So you're getting literally a higher dollar amount of dividend for the same security. That is keeping rates, yields elevated in the space despite the fact that prices have improved. All of which is to say yields are pretty good, And if you take a look at the chart that I brought along, it shows the price of preferred shares over the last 10 years. We convert the index to a weighted average versus par, which is $25 a share. And you can see how pricing is really sort of accelerating above that fair value range. And so it's an area, we're into the zone now where like the yield is attractive. We still have redemptions to come in 2025, which will support the market, but there's not as much potential for capital gains. So we're not as bullish as we would have been this time last year because, as you can see, there's not much more upside from here.
When you talk about an investor, particularly a retail investor, might be taking a look at the space. Obviously, there was a moment there where a GIC, which is considered a pretty conservative investment, was giving you well above 5%. A lot of money moved in that direction. That is not the case anymore. Good luck to you if you're going to go out and find a 1 year or a 5, between a 1 or 5 year GIC paying out, that kind of thing. Does that make the space a little more interesting for the retail investor?
It does. That's a good point. There is a substitution right now from cash to anything else as those short-term interest rates have come down and GIC rates have come down. People are looking for yield in other areas. And so preferred shares are one of the obvious places where you might want to look because yields on perpetuals are over 6%, yields on floaters are still 9 or 10%, and rate resets in the 6 to 7% range. So the yield is enticing. When we think about it, for our portfolios, we don't just think about yield. We also think about the sort of the upside and the downside potential. And because credit spreads are so tight, it's hard to be really enthusiastic about the upside from here. I think it's prudent to be a little bit more balanced in our approach. So that's why I say neutral. But yes, like people are going to look for that yield, and some of them will go for it.
Is that what a retail investor needs to be aware of in the space? Because obviously you might have a firm understanding of equity, a firm understanding of fixed income, and then in between we have the preferreds. If someone's starting to do their homework in this space on their own, what should they be looking at?
There's so many things to look at. I think it always starts and ends with credit risk because you're buying paper in the companies that are issuing these preferred shares. Big names in the index like Enbridge and Brookfield Corporation. The banks, the insurance companies. These are well-established, stable businesses, and so the good thing about the market is that it's not high yield, it's not speculative. It's a good, solid market. But there's credit risk you have to consider. There's interest rate risk because the rate reset mechanism means that you need to think about where rates are going to be 5 years from today, which is of course very difficult to predict. And then the spread that's attached to each type of security, it can range from as low as 100 basis points to as high as 400 basis points or more. So there's different levels of credit risk, interest rate risk. There's a lot of other mechanisms that can go into it, like supply and demand in the market. And so there's a lot of things to consider, and that's why we actively manage our portfolios.